Good evening, everybody. We're getting settled as we speak. We're getting settled as we speak. Good evening, everyone that's tuning in right now. We are a few minutes behind. We just experienced some technical difficulties on our end with sound and audio again. We're going to hope we get through this entire broadcast here tonight without it. But very briefly, I'll let Andy give himself a light introduction to who he is and what we're going to be covering tonight.
Yeah, first, thanks, Matt, for doing this on a rainy Sunday night. I appreciate everybody tuning in and for you guys tuning into what I think is an extremely important topic for not only the mortgage side, but as a real estate sector as a whole. And it's the conversation of mortgage forbearance versus deferment and the potential impact that it has on all of us. I am the Divisional Vice President of Envoy Mortgage in the Northeast. I've been here 5+ years. I've been in the business for 28 years now. So I've been doing it a long time. I've seen a lot of things in this industry, nothing quite like this or anything that rivals anything close to this. Even the meltdown pales in comparison to kind of what we're faced with now. So appreciate the time again tonight, Matt, and look forward to hopefully maybe adding some clarity to an otherwise very vague topic.
Absolutely. I appreciate you taking your time again. Like you said, on a Sunday night, it's just past 8 o'clock, and I'm excited to have you here tonight with me to have my back in terms of your education, your experience.
Yeah, my pleasure, bud.
So what I'm doing now here, I'm just going to make sure you're tagged in this post real quick so it shows up live on your feed, and then we're going to get this conversation rolling a little bit. Like I said, tonight's topic of discussion is heavily geared towards real estate professionals and homeowners. All right, so let's go edit. Give me just a second here, folks. Tag here. Andy, on your end, how's everyone holding up? Your family staying happy and healthy over there?
Yeah, I mean, look, it's not easy, man. When you're looking at the same four walls all the time, people start to get a little stir crazy. But overall, it's allowed us to maybe explore some things as a family we haven't been able to do in a long time. That downtime allows you to have conversations you don't normally get to have, share things you don't normally get to share, good, bad, or indifferent. But everybody's health is good, everybody's healthy, and that's the most important thing.
Same, love it. Okay, so I think I now have you successfully tagged in your page, so your viewers can now successfully see this as well. And what I'm going to do is get back to my main page. Folks, thank you for your patience again tonight. Andy Patola here, my leader, SVP of the Northeast Division, and myself are just taking, we're going to try to keep this short and sweet and very direct. We also would love some questions and comments to address as well. And we're going to talk about the difference between deferment, forbearance, and the mortgage industry as we are approaching May 1st mortgage payments. So my perspective on this is this, guys. As a home mortgage loan officer, I've taken the responsibility upon myself here on a Saturday morning to make sure I reached out to every single one of my past homeowner and my past clients, and just having a conversation with them about their family, making sure everyone's happy, healthy, employment, seeing if they've been laid off, furloughed, etc., and just identifying what situation they're in financially and seeing if they have any questions about forbearance or deferment. And successfully today, I haven't ran into any problems in regards to those two terms. And I can happily say that based on my business practices that I was taught by Andy here and my other leaders here in the local branch, we set up our clients for success in terms of when we reach pandemics like this, which come around once in a blue moon, that our clients were set up for success in terms of their mortgage payments aren't outstretched themselves. So I got some very positive feedback today. I was very happy to hear that. But basically, in a nutshell, this, guys, just to get into the meat and potatoes, forbearance and deferment, 2 words right now in the mortgage industry homeowners are using a lot. Unemployment numbers, Andy. Unemployment numbers last week hit 26 million.
Yeah.
Correct?
They were up 4.4 million over the last report, up to 26 million, which represents almost a 3% increase over the last gathering of data, and now represents over 11% of the workforce in the United States right now. So it's a significant number, and for all intents and purposes, and the way it's trending, that is only going to increase over the next month, as well. So it's a very real problem, and it is growing incrementally.
So something we don't want to downplay here, right, is this pandemic is a ghost that hit everybody when they saw it coming. And there are folks out there that are homeowners that are currently out of work, entire household. They don't have enough savings to pay their mortgage. These are the folks that should be and can be taking advantage of this forbearance deferment topic of conversation. The thing that bothers me the most is hearing some stories and listening to some podcasts and some other mortgage professionals talking about some of their folks and clients, et cetera, they've talked to that are simply going into forbearance to simply go into forbearance because they not have to make 4-month mortgage payments, or et cetera, and they think it's doing them good. When really these folks are still employed, they're still receiving checks, they have X amount of savings, they could be making their mortgage payments. And I just don't think that everybody understands the actual repercussions to going into forbearance, not only to the homeowner, but to the mortgage industry, to the real estate industry, and just the overall scope of what they're doing to their financial portfolio themselves of skipping 4 mortgage payments at a minimum. So, deferment, Andy, you can speak on this. I'm going to let you take the ball after this here, but guys, forbearance, in a nutshell, forbearance, hypothetically, say you do not have to make 4 months worth of mortgage payments. Come that 5th month when that mortgage payment's due, it's not just going to be that single one mortgage payment. And generally, it's going to be a lump sum of the 4 months that have missed as well as the 5th that is due. Deferment is more of missing, say 4 months worth of mortgage payments, having a 5th month due. But hypothetically, let's say your mortgage payment is $2,000 a month. Now you might be paying, say, $2,500 a month, and you're going to pay that extra every single month until you recoup that. Andy, with 28 years here experience, I think is going to be able to break this down into more layman's terms and simplistic, but as well as bringing that education value to homeowners that watch this video now live or replay, but as well as realtors and any other real estate professional guys. Take this responsibility upon yourselves to educate your clients, to educate your coworkers, to educate any real estate professional of the importance of this message about forbearance and deferment. We are in unprecedented times where there are families here that have mortgages that can't pay them. Take this forbearance and deferment and do it if you have to. If you do not have to, please refrain from it. If you have to run yourself tight on your savings, run yourself tight on the savings and pay your mortgage the next 4 months till you're back to work. And Andy, I'm gonna let you kind of take the ball here from there and get into some of the repercussions of forbearance and what we're seeing in the mortgage industry on the servicing side.
Yeah, and first I want to make sure that we're very clear that those are 2 separate and distinct terms, right? Matt, you did a really good job on that. And to break it down even further, a deferment is essentially much like a forbearance. It's a suspension of the payments, right? But a deferment, interest isn't technically accruing for the most part when you do a deferment. So if you say, hey, I want to get a deferment on my loan and I want it to be for 4 payments, those 4 payments will be reallocated either to the end of the loan, right? Or they'll be spread out over the life of the loan into smaller increments so that there isn't a big payment shock. But there wouldn't be interest accruing on those payments. It's specifically taking payments, 1, 2, 3, and 4 and moving them in one way, shape, or form to another part of the loan. Forbearance is entirely different, right? And that's what we're faced with now. A forbearance is similar in one respect that there is a 1, 2, 3, 4 payment that gets moved, but it gets moved to a very specific moment in time. And at that moment in time, interest has been accruing. So not only do you owe those 4 payments, but now you owe the interest that's accrued on those payments that you requested the forbearance on. So it is a potential huge, significant financial impact on the borrower when that 4-month window is up, right? So that's issue number 1. And the bigger issue is there's really not a barrier to entry, right? In the days of the financial crisis, the previous one, to get a mortgage modification, a deferment or forbearance, you had to prove financial hardship, whether, submit a pay stub or submit something that proved that you were laid off. With a forbearance now, it's as simple as a phone call, or sometimes they're even automated. You go online and say, hey, I'm being affected by the COVID-19 situation. I'm requesting my mortgage to have a forbearance for 4 months or up to 180 days. And you're getting granted that almost carte blanche with really no proof whatsoever. And because of that, we have people recklessly advertising that, hey, you can get into a house now and not pay your mortgage for 5 months. Little do they know the repercussions, what happens in month 5, when those 4, not only are those 4 payments due, but the 4 payments plus the interest that's accrued on those 4 payments are due on top of it. Now, what's also unspoken is the financial pandemic that has been created because of this forbearance situation. And what I mean by that is there's 2 owners of a loan after a loan closes. Someone owns the servicing and then someone owns the actual loan, right? The servicer is the one that essentially collects payments, pays taxes, pays homeowners insurance, and does that servicing component for the owner of the loan, whether that be Freddie Mac, Fannie Mae, or Ginnie Mae, who owns it, who pretty much does FHA and VA loans, right? So the servicers in a forbearance are required to continue paying that loan for the owner of the loan, right? Fannie, Freddie, or Ginnie. They have to continue paying that loan during the 4 months, even though they're not collecting any payments from the borrower. That's an incredible financial burden that's been put on those servicers. So what the servicers have done in turn, they've said, hey, we can't afford to do this based on how quickly the numbers of forbearance are growing. They grew over 3%, just like unemployment did. And they only have a finite amount of resources that they can continue to pay on these loans that they're not getting any income on. So what's happened is they're saying, hey, we're not buying servicing right now. Or if we are, we're buying very limited. So that's pushed back on the mortgage lenders themselves, who now have to retain servicing. And again, the smaller and even mid-sized intermediate mortgage bankers only have a finite number of resources to hold their own servicing. So there's a massive effect happening all over just from this forbearance scenario. What further exacerbated it this week was that we finally got some guidance from the governance of all the agencies at FHFA, right? And what they said was, we are going to make the maximum amount of exposure for the servicers 4 months, okay? Which means that the servicers are only responsible for paying the loans, taxes, and insurance on forbearance loans for 4 months, regardless of how long the forbearance goes, right? They also said that in conjunction with that, we will continue to buy those loans. In other words, we'll keep them in the MBS pool and we will continue to buy those loans. Now, what that should have done was given the servicer some confidence, because typically when a loan goes into forbearance, that's considered a hardship loan. And the GSEs, Fannie Mae, Freddie Mac, and Ginnie Mae, have every right not to buy those loans. A hardship loan, foreclosure, bankruptcy, those are also hardship loans. So they have every right to deny the servicers purchasing of that widget, which means they're stuck with it forever. So they came out and said, you know what, we're going to eliminate some of that hardship loan, and we are going to buy those loans within that 4 month window. We're going to maintain their eligibility. That would have been great for the industry, except for the fine print. The fine print said, we will still buy them, but now we are going to charge you 500 basis points for that loan if it's a first-time home buyer. We are going to charge you 700 basis points if it's not a first-time home buyer. And oh, by the way, cash out refinances, we're not buying it. So the servicers in one breath, they read the first paragraph and like, oh my God, this is great. There's going to be some sanity added to what was previously insanity surrounding this forbearance scenario. And now it's been further muddied and created way more uncertainty. And if it doesn't get remedied or clarified or changed, it can have incredibly negative effects on the industry as a whole. So that's go ahead.
That's where I don't want to butt in. That's where we're coming into play right now.
Yeah. And that's
as real estate professionals, realtors, mortgage loan officers, we need to take it upon ourselves to educate our clients, our current clients who are going to be buying a home now, our past clients, and all of our business professionals here that we're doing business with. And also, I know for a fact that we have other higher industry powerhouses that are going to bat against the FHFA and letting them know, like, that was great what you came out with, but the fine print reading that when you have to pay 500 bips and 700 to get rid of the loan, that's not the solution to the problem. So, and even to mitigate that solution to the problem, the big message here we need to make is that forbearance and deferment is not a free ride. It is not a free ride. There are repercussions to everybody that's involved in this scenario, and it needs to be taken very seriously, and the message needs to be heard and spread as quick as we can, because we're coming up on May 1st mortgage payments, Andy, and I know April 1st, was it 5% mortgages? Was it 5% mortgages were into forbearance? Yeah,
they grew by almost the same percentage as the unemployment number did. They grew almost 3% to 5%.
I don't want to see what I'm not looking forward to seeing what that number looks like rolling out, say, a week or two after when we get into May. And that's why we're doing this. We're trying to bring the awareness to the real estate professionals out there. Everybody who's purchased a home as a homeowner now, who's hearing this term forbearance and maybe thinking, oh, it's a great opportunity to miss payments. It's not. Unless you have to. Don't take the message here isn't trying to be portrayed wrong. Like, if you're unemployed, if you're financially hurting because of this pandemic, then that's why these actions are put in place, so you can take this upon yourself. But if you have a job, if you have savings and any ability to make that payment, please do, because you're going to be hurting yourself in the long run, as well as you're going to be, like Andy said. So let me try to frame this up for everybody here who is not so much the 28-year veteran of the business in terms of this. So picture this as a rental unit of a property. There's tenants, and let's say the rental unit of the property has a superintendent, and then there's also the owner of the property. So the tenants pay the superintendent forwards the payments onto the owner, who is the bondholder. So let's call it this way, guys. The bondholder is the bondholder is the owner, the superintendent's the servicer, and the tenants are the homeowners. So the homeowners, let's say, go into forbearance, they not make their mortgage payments. Well, in turn, that servicer is now still obligated to pay the owner, the bondholder of this scenario. In our case, that's where we stand here. That's where we're at. Anybody who's going into forbearance and not sending us the monthly mortgage payments, we are still now having to make those payments for X amount of months to the bondholder, to the owner, to the investor who owns that mortgage. So what that does is it takes down capital. It's going to extract liquidity from the mortgage industry as a whole, and it could have severe side effects at the end of the day. And this isn't a video to scare. This is straight education we want to get across. And Andy, if you have anything there that you can add to it, any adjustments, I'd love to hear it. I'm going to search here on some comments. I want to see if we have any questions or comments at all to attack. Yeah, no, Matt, again, and that's a great way to look at it. At the end of the day, forbearance, it's not a tool. It's a necessity for people that are truly being impacted by being furloughed, by being laid off. And it's an absolute, in those scenarios, guys, absolutely, it's something you need to take advantage of. But even if you are taking advantage of it, please understand how it actually works, right? And I would contact your servicer, not just to get a forbearance if you're in that scenario, but truly understand what the ramifications are going to be 90 days or 120 days down the road. Because you may owe a big lump sum, and you may owe not only a big lump sum, but a big lump sum of 3 or 4 payments with interest on top of it, right? Mm-hmm. So again, it is an absolute necessity for the people that need it. But the purpose of this Facebook Live tonight is to just make sure that we're creating the right awareness, that for the people that use it, absolutely, you have to do it. But for those that don't, this is not a vehicle, it's not a tool, and the ramifications go well beyond Joe Homeowner, right? It trickles down and could have a crippling effect on the industry as a whole. And that's realtor, that's everyone. That's real estate attorneys, that's real estate agents, and that's mortgage professionals in every sector. Broker, retail mortgage banker, and huge correspondents. It will affect everyone. Yeah, I'm very happy to have you on this call here to bring this knowledge of value to everybody. I hope it's showing up live on your page like we anticipated. It didn't happen the first time around. So I do know we do have an investor here. He's a homeowner himself, multifamily properties. Daniel here, and I'm just going to read his comment through. I haven't gone through it. I'm not ready yet, but I know he was looking forward to this call tonight. The Schiller inflation adjusted home index showed we're still high on home prices. How do you see the large volume of forbearance impacting volume and prices in the future? And have you seen lower volume of applicants? To what degree are you seeing tightening lending to small, medium residential investors, not just owner op loans? So that's a multi-part question, right? So I'll start with the easiest one first. The whole forbearance action, right, and the activity around forbearance has created a tightening and restriction in all lending, right? Because as I mentioned before, if the servicers are not buying loans because they're worried about having to make the payments on all of these loans that go into forbearance, then the individual independent mortgage banks, retail mortgage bankers, and correspondents are holding those loans. So they're not used to that. And maybe they do some servicing, but not to the degree that they have to do now. So they're going to impose what we call overlays in the business because they're retaining those loans. So they're going to try to make those at the least risk as possible to them. So you're going to see much tighter lending restrictions across the board. You've already seen it almost across the entire channel. Almost every investor has gone to higher FICO scores on FHA loans. They've either limited or eliminated manual underwriting. They've added maximum DTI calculations to government loans. So you're already seeing that across the board. Now, in terms of new applications, are we seeing as robust
an influx of purchase applications as we would normally see at the end of April and heading into May? No, but the good sign is we are still seeing a ton of activity. So that's a great sign. Even though the unemployment numbers continue to rise, even though the number of forbearance requests continue to rise, we are still seeing a lot of activity in new credit repulls and new pre-approvals coming in, and it's all purchase business. In terms of home prices, it really can go either way at this point, right? It really depends on what happens over the next couple of months. If the further the fear spreads, the more it's going to become a buyer's market, right? And prices are going to suffer because of that, because you're going to have people that are going to wait. And there's going to be a lot less multi-offer scenarios, which are going to drive the price up, right? I think there's going to be more supply than there is demand. Is
it safe to say that it's not just not industry specific, what we're talking about here, but it very well maybe regional specific and state specific in terms of volume, in terms of home values and prices and volume? Because I'm hearing some states in these groups have been on Facebook and podcast things I listen to. There's different states and different regions throughout the country that are taking the hit more directly in terms of home values, multiple offer situations, and activity.
Well, think about it from this perspective, right? The Northeast, we're in a very unique scenario and not the greatest, right? Because our spring market comes much later than certain parts of the country, because we still have the tail end of winter that kind of goes into spring, right? We saw snow at the beginning of April, right? Which precludes people from doing open houses in some scenarios, and usually makes our spring market start a little bit later, but then last a little bit longer than the West Coast and the Midwest, where the weather is pretty stable throughout January, February, and March, right? So we already have that working against us. Secondarily, kind of the true Northeast, right? New York, Connecticut, New Jersey, Massachusetts, we're probably going to be one of the last states to open up, right? And that's going to preclude us from truly being able to have as much access to open house and showings and maybe less fear of buyers going out and doing those activities than in other states. We're already seeing that some of the states in the Southeast are opening up as of this week, possibly. South Carolina, Georgia, they're going to open up fully. So you're going to see their spring market potentially hit quicker than ours does because of some of those other factors. So it is going to depend on when states open up. And it's going to depend on some of those other factors as well.
Yeah, I mean, in terms of home values too, I mean, like we know, we've seen a steady increase year after year after year after year. So if we do have a year, 2 quarters, if we have a full 4 quarters, 1 year's worth of time lapse here where we don't see a significant increase in home values, I think we're still going to sustain a strong housing market, especially given where interest rates still remain even through this pandemic we're currently in.
I will tell you that with a certain amount of certainty, right? And maybe not just my certainty, but talking to a lot of veterans that I know that I have a lot of trust in that have as much or more experience than I do, that we are probably on the precipice of at least a 24-month window of continued historically low interest rates. Just based on the number of the trillions of dollars of MBS purchases that were already made and what's going to continue to happen, the housing market needs to sustain it's still the basis of all the financial success in the country, right? It still represents the greatest opportunity for liquidity in our financial markets. It all starts and ends in real estate. So I think we're in the beginning of what could be a tremendous 2021 and even better 2022. We have to get through this uncertainty in 2020, right? But I think we are in the very beginning stages of a sustained low interest rate environment.
Yeah, I mean, when you go online, when you go on the internet, you're going to read both sides, whether it's good or bad. You got the people who think the housing economy is going to crash. You think it's like 08, 09 or 7, 08, whatever. And then you got the folks that are saying that we are going to see actually better interest rates potentially moving forward. We're going to see more volume purchase refinance opportunity moving forward in the next not only year, but 2-3 years to come. Nobody can completely forecast that and hit the bullseye with the dart. But what you can do is look at past historic trends and time frames, whether it's 15 years, every 30 years, every 50 years, every 100 years of economic trends. And from the research I have done and everybody who I've listened to and all the podcasts and stuff that I've listened on and read on, we should be headed in a good spot. And where we're at right now is a lot of fear. And fear is a great time for opportunity. And when I say that, the first thing I think of is when you're talking about real estate in general, everyone's making adjustments to their business. You see people doing Zoom calls. You see, folks doing, instead of going out to lunches and breakfast, now we're doing virtual. So what's that going to do? It's opportunity to save time and money. Businesses, opportunity to potentially bring their scale down of office sizes. There's going to be a lot of changes to be made. But where we are right now, there's a lot of fear. But at the same sense, there's a lot of opportunity for everyone to take of this as well within whatever industry of work you are in, or whatever industry of work you choose or you desire to do. Right now is a time to hammer down. And I really hope everybody's taking advantage of the video aspect of this life, of the Zoom meetings, of the virtual stuff. And that's what we're doing here tonight. You know, we're trying to bring it live. Andy, I brought you in at 7:56. And what happened? We didn't get on until like 8:03 because we had technical difficulties.
Yeah.
I might have to figure this out because it happened to me the Facebook Live I did with a realtor earlier this week. I completely froze. We had to go take two. This is technology. This is live. This is real, raw content. This isn't scripted. Andy and I didn't talk about this prior to. I didn't talk to you all day. No. We simply jump on and we're going to go at it.
Yeah.
The focus of this video, folks, is to bring value to you guys, answer any questions you may have, but as well as like the awareness, guys. The awareness I'm trying to bring, the awareness Andy's trying to bring, the awareness my coworkers are trying to bring to real estate professionals, to homeowners, is that forbearance and deferment are serious terms. They should not be thrown around lightly. And if you have any comments or questions, you need to reach out to your mortgage professionals and have that conversation with them and understand the impacts to you, to the mortgage industry, and overall the real estate industry and the ripple effects it's going to have, because it's not a free ride. That's about as blunt as I can put it, buddy.
Well said, bud. Well said.
You know what I'm saying? So I think we have some good following, which is great. I've seen a lot of folks here hop on, realtors, title company reps, some past home buyers of mine as well. I'm really glad these folks are hopping on, whether they're watching it live or on the replay. It's all good. But what we got here, Daniel, so right on the Fed is bailing out the bondholders. So the Fed is bailing out the bondholders for homes with many alphabet soup programs already. Can't do that forever, though. We'll see how it plays out. And good to hear the volume is still good. I mean, in response to that, on my aspect is, yeah, I mean, you can't just keep getting bailed out for so long. But the fact of the matter is this is, I was watching a YouTube thread earlier, MBS Highway, and they were talking about this 08-09 difference to where we're at now. And when the Fed stepped in 08-09, we were so far too late and in depth into the crisis that there was no saving it. There was no coming back. And in this term here, from my understanding, I want to make this clear, so my first real estate mortgage industry pandemic that I'm dealing with of a recession. We are in a recession for sure. And we're in the exact opposite, because the Fed jumped in ahead of time, on time. They're not late here. But what they're throwing in, can they keep doing it and doing it and doing it and sustain it? No. But what they're doing now is certainly giving us, I shouldn't say cushion, but it's giving us some leeway to make the adjustments. Mainly, man, I really hope that the powerhouses in the real estate and mortgage industry, Wall Street, you name it, really get in front of the FHFA and make the proper adjustments for the servicing aspect of this industry, so we don't see significant repercussions from it on this aspect.
Yeah, guys, lobby your congressman, right? And lobby your governing bodies. Realtors, lobby your governing body, right? Because they've been very vocal in this. Mortgage professionals on this call, NAM has been huge in terms of getting in front of this and elucidating the pitfalls of potentially what we're faced with. So what we can do as an industry and as professionals is we have to be a voice. And we have to be a unified voice, right? This isn't a time for ego. This isn't a time for hashtags. You know, I've been in constant contact with a lot of my peers from quote unquote competitors over the past months, and we've bonded in a way that we haven't bonded before. It's not us against them anymore. We need everybody to survive this, right? In certain instances, you're like, oh man, it would be great if, let's just say, one of our massive competitors wasn't here. Well, guess what? That's not the case anymore. We need everybody to survive this, right? For a lot of different respects and a lot of different aspects of this. We need everybody to survive, and the only way to do that is to be stronger together. That's the only hashtag we should be following right now.
Andy, can you see me and hear me still pretty clearly?
Looks like Matt froze again. Oh, there he is.
Can you hear and see me clearly? Oh man.
You there?
Can you hear and see me clearly?
Yeah, you froze for a minute there, man.
All right, let's do this, man. Let's please, whatever you have on your mind,
You're in and out.
give them a conclusion, because we're gonna wrap this up before we hit the fan. Oh sugar. Oh sugar. Yeah. Can you hear me?
Oh, you're back now. Yeah, you're back now.
Hey, drop them, leave them with, if you have anything to leave them with for conclusion and importance of this message here we tried to bring tonight, please leave it now.
Yeah, guys, look, at the end of the day, this is an extremely hot topic. It's an extremely important topic, and there's a lot of misconceptions in or around the topic. Feel free to friend me on Facebook, send me a private message. I will give you any information that I can. I will share some of the industry insights that I get on a daily basis. Whether you're an investor, whether you are a realtor, whether you're a consumer, I make time for everybody, as does Matt. And it's time to be a resource. And I think that that's the only way for us to get through something like this. And to be a resource, it's about sharing knowledge, and knowledge will tend to put fear away, right? It's the only thing that can truly quell the uncertainty and fear that we're surrounded with. Knowledge can do that. And I'm more than willing to do that. That's why I'm doing this at a Sunday night at 8 o'clock. I think it's that important. So appreciate you, Matt, and appreciate you giving me the opportunity, and for you taking the time out to do this, and for everybody that tuned in. Like I said, PM me, PM Matt. We'll be more than happy to answer any questions that you guys might have offline.
Very good. I got one final message for you folks too. Kurt, thank you for that message. I'm going to be contacting this software. Andy's finally clear on my screen again. Thank gosh. It comes back to the first time. You are just as handsome in person as you are in camera as well. Kurt, thank you for that. So yeah, my mother goes, LOL, why does Andy have a Steelers thing behind him? Andy is a huge Steelers fan. Big Spider-Man guy. He's ready to roll. Let me get my conclusion out here so we can stop this live before it all hits the fan, because it happened earlier this week. I got to contact the software company, get this squared away. Guys, in a nutshell, Andy Patola here, my leader, SVP of the Northeast Division, 28 years experience. He takes his time to come out of his Sunday night to do this with me. I can't be any more grateful for this. Everything I've learned from day one of training to the professional I've become today is because of him. The message we are bringing right now is to all real estate professionals, all homeowners. Please don't take this lightly. It's not with a grain of salt. Please educate you, your team, your coworkers, your past home buyers. Forbearance and deferment is not a free ride. Forbearance and deferment need to be understood. The repercussions are serious for the homeowner. The repercussions are serious for the real estate industry, and the repercussions are serious for the mortgage industry. If you have any more comments or questions, guys, you've got Andy's information. I hope he's tagged in this video. I hope it's live on his page, because we tried to do that. And Andy, can't thank you enough. I can't wait to see you again in person.
Yeah, man, I can't wait either. I can't wait to see a lot of the people on this feed in person again. So stay safe, stay healthy, everybody. Enjoy the rest of your weekend, and can't wait to do this again soon. Thanks again, Matty.
Thanks, Andy. Thank you, everyone who tuned in, and take care.
Bye.